Hey everyone, and welcome to Talk Tickers. Today we are diving deep into the after-hours earnings call from Jack in the Box. We're talking Q4 fiscal year 2025. Let's get into it. All right, so here's the game plan. We'll kick things off with a snapshot of the results, then do an operational deep dive. After that, we'll look at their Jack on Track plan, put it all into context with their guidance, and then, the big one, our prediction for what's next.
Okay, so let's jump right into the results. And you know, this quarter was a real head-scratcher. It's what I'd call a quarter of contradictions. And boy, did it send the stock on a wild ride after the bell.
And if there's one number you need to remember from this entire report, it's this one, a 35% miss. I mean, we're talking about a huge miss on earnings per share compared to what Wall Street was looking for. Ouch.
So here's where things get really weird and kind of fascinating. Take a look at this. The company actually beat on revenue. They brought in more money than expected. But, and this is a huge but, their profitability just fell off a cliff. I mean, earnings per share went from over $1 last year all the way down to just 30 cents. The top line looked okay, but the bottom line was a disaster.
And you gotta remember, this isn't just a one-quarter problem. The stock has been getting hammered for a while now. Look at this chart, down almost 70% while the S&P 500 is up double digits. That really sets the stage, right? This was a super high-stakes earnings call for them.
All right, let's peel back the onion a bit. To really get why the numbers were so messy, we have to look past those headlines and see what's happening at the store level. There are some serious cracks in the foundation here. And wow, this chart right here, it pretty much tells the whole story. The main brand, the namesake, Jack in the Box, is seeing sales fall at nearly double the rate of Del Taco. And the crazy part? Del Taco is the brand they're getting rid of to try and simplify things. It's ironic, to say the least.
You know, you got to give management some credit for being blunt about it. The CEO basically came out and said our value equation was not resonating. In plain English, their deals, their prices, they just weren't working. Customers weren't buying it.
So what caused that profit collapse we talked about? Well, it was like a perfect storm of bad news. When sales fall, everything gets more expensive per item sold. On top of that, food costs were up almost 7%. They're opening new stores in Chicago, which is really expensive up front, and to top it all off, they had to spend an extra $5.5 million on ads, basically just to try and get people in the door.
So, with results like these, you know management has to come out with a plan, right? And they have one. They're calling it the Jack on Track plan, and it's their big blueprint for a rebuild.
And the plan is pretty straightforward. It's really a classic turnaround playbook. First, sell Del Taco to simplify things. Second, close down a bunch of stores that aren't making money. Third, sell off some of their real estate to raise cash. And finally, take all that focus and capital and pour it back into the main Jack in the Box brand. It's all about getting smaller and more focused.
And what's the big financial goal of all this? It's this number right here, $263 million. That's how much debt they're planning to pay down using the money from the Del Taco sale and everything else. For them, it's all about fixing the balance sheet right now.
And the CEO was really clear about the timeline. He said 2026 will very much be a rebuilding year. What he's telling investors is, look, don't expect a miracle overnight. This is all about resetting expectations and telling everyone this is going to take some time.
So this rebuilding year, what does that actually mean for the numbers? Well, let's look at the guidance they gave, because it definitely paints a pretty sober picture of the road ahead.
Okay, if you look at their official forecast for next year, it's not exactly inspiring. They're telling us to expect same-store sales to be somewhere between down 1% and up 1%, so basically flat. And they're confirming they'll be closing a lot of stores. This isn't a V-shaped recovery story. This is a let's just try to stop the bleeding story.
And you have to remember, they're trying to pull off this turnaround in a really, really tough environment. Restaurant traffic is slowing down everywhere. They have huge exposure to California, where the new $20 minimum wage is a massive headwind. And all the fast food places are in an all-out value war for customers who have less money to spend. It's just a brutal backdrop.
All right, so that's the situation. The big question now is, where does the stock go from here? Let's tie all of this together and get to our prediction. And this really is the million-dollar question for anyone looking at this stock, right? Is Jack in the Box a deep value play, or is it a value trap? I mean, the stock's been crushed. Is this the chance of a lifetime to buy low, or is it a warning sign that things are about to get even worse? So here's our call. We think the pain we saw at the end of Q4 is going to bleed into the first quarter of next year.
The street is already expecting a pretty bad quarter, but we actually think it could be even worse. We just don't believe consensus estimates are fully pricing in how tough things are right now, which could mean another earnings miss is on the way.
Because of all that, we're initiating our coverage with a market perform rating. What does that mean? It means the plan they've laid out makes sense on paper, but there's a ton of risk in actually pulling it off, especially with the economy the way it is. The risk and the potential reward feel pretty balanced right now. Basically, it's a show-me story. They have to prove they can do it.
Now, for those of you who are more active traders, all this uncertainty creates a really interesting situation. Instead of just betting if the stock goes up or down, you could look at a strategy that profits from a big move in either direction. The idea is that the next earnings report is going to be a huge test for this management team. It's a referendum on their credibility, and that could cause the stock to swing wildly, and a volatility trade could capitalize on that.
And of course, we have to say, this is not financial advice.